Good day, family. Welcome back to the Young, Black, and Wealthy YouTube channel. And today we're going to be talking about what we look for when we purchase a dividend growth stock. Don't forget to like, comment, subscribe, and share with a friend. So let's go ahead and get this video kicked off. And by the way, too, please go to our Instagram page, which is Young, Black, and Wealthy, and our Facebook page as well, Young, Black, and Wealthy. So I usually post quality dividend picks on our Instagram and Facebook page, usually twice a week, and it's laid out in a particular way, and usually has the share prices first. So we're going to talk about the share price. For me, this is out of everything I'm going to go through with you guys, this is the thing that I probably care about the least as far as quality, and that's because the share price doesn't really tell you much about the quality or value of the business at all. We do take share price into account because we want to know, can we afford the stock, basically. Other than that, it's something that we don't really focus on too much. We put it on the post because we want to let people know what the particular stock is trading for at the time. So the next thing is dividend and yield. The dividend, you're going to see, users can go into your brokerage account and they'll tell you how much you're being paid out annually, and they'll break it down into quarter as well. The next thing is yield. Yield is the amount you're going to be paid out based upon the share price. Yield is important because we want to be paid out a relatively decent amount based upon what we're actually paying for that stock. So we like yields between 3 to 5% or more, but you definitely have to be careful and look out for what is known in the investing world as yield traps. And a yield trap is basically a stock that has a very attractive yield. Sometimes you see them there anywhere from 12 to 17%, and you get into these stocks and they end up getting cut or suspended, and that's because the yield is just too high, and so it's not sustainable. So that's something that we need to make sure that we're looking out for, because so many people I see in my group and just generally, they go look at a business's share price and they say, oh, well, this share price is cheap. It's $5.50 and it's got a yield of 15%. I look at those stocks and I'm automatically get scared, because I'm saying, well, you know what? With a yield this high, this dividend is probably not going to end up being sustainable. So they get in, and next thing you know, they're getting a cut. Now, if you know what you're doing and you want to get into that stock, knowing that it's a great possibility that the dividend might be cut or suspended, that's fine. But when I purchase dividend stocks, I want to get into that stock the majority of the time for a long time, and I want to be able to earn off of it. So just make sure you keep that in mind as well. And we're going to move on to the next one, and the next one is payout ratio. This is the biggest one for me. Payout ratio is the amount of net income or net profit or earnings that is paid out to shareholders. So basically, after a business pays all of its bills, some of the money that's left over is paid out to shareholders in the form of a dividend. If that payout ratio is too high, it kind of goes back to what we talked about yield traps. If that payout ratio is too high, there's a great chance that that dividend won't be sustainable over the long term. Ideally, they say that the payout ratio should be between 30 and 50%. That's in a perfect world. We don't live in a perfect world, so we definitely do purchase stocks that has a yield below 30%, and also we purchase stocks that have a payout ratio that's above 50%. So the thing is when you start getting to that 90 percentile range, or 100, or even sometimes you see stocks in there above 100% payout ratio, you need to be careful, okay? Because that dividend is not going to be sustainable. What happens is a business either has to take on debt to pay out the dividend, which is never a good thing, but most likely that business is going to cut or suspend that dividend. That's something that we don't like either. But you need to make sure that you look at the payout ratio. You can simply go put the stock name in and put in payout ratio, and you'll see certain sites, MarketBeat and Guru Focus, they'll tell you the payout ratio. If that payout ratio is exceedingly high, just be careful. Or if you have a plan for it, then go ahead and enter it, but just know that it's a possibility that that dividend is going to end up getting cut. The next thing is dividend growth streak. This is another big one for me. You got companies like 3M. They've been paying out a dividend and growing the dividend for 62 years. That's longer than I've been alive, and probably the majority of the people that's watching this video, that's probably longer than you've been alive. That shows a real commitment to shareholders, and that's something that I like to look at because it says a lot about the business and management. So basically, the dividend growth streak shows the historical commitment to returns for shareholders. The next thing on the list of things that I like to focus on when I'm purchasing a dividend growth stock is dividend growth rate, which some people call it the compound annual growth rate of the dividend, which is the percentage that dividend is being grown every year. So we particularly like stocks that are growing their dividend by at least 5% a year, at the least. We do purchase some stocks that are growing that dividend a little bit lower than that if the dividend is well covered by earnings. So definitely look at the dividend growth rate, because it's going to let you know. And you can simply Google that as well. It's going to let you know how much that business is growing that dividend every year. And it's just another track record. And these are things, that we need to know, because we want to know what we're going into, what we're getting into. So, and overall, these things say something about business quality, which is something that I talk about, and I know people get tired of me talking about all the time. We want to be purchasing quality businesses if you're long-term investing. Trading is something totally different. But if we plan on being in these businesses over the long term, and long term for you might be 5 to 10 years, but for me it might be 20 to 30 years, we need to be paying attention to these particular things that will show us commitment and the overall quality of the business. So just make sure that you are looking at these things when you're purchasing a dividend stock, because it's just important for us to make sure that we are buying a stock that has a dividend that is sustainable. That's a big word, sustainable. So those are my those are the things that I look for, and I definitely appreciate everybody that is supporting Young, Black, and Wealthy. Our channel is growing, our group is growing, and I also definitely got to give a shout out to the Young, Black, and Wealthy group that's got over 2,200 people in it now. This group is just growing like crazy, and we laugh a lot. We debate and argue a lot, and it's just really something that helps keep me going. It keeps me motivated, and it keeps me inspired as well. So shout out to everybody that's in the Young, Black, and Wealthy group. And if you are interested in joining that group, just go to Facebook and type in Young, Black, and Wealthy, and just hit join, and we'll add you. So I definitely appreciate you taking the time out your day to watch this video. Please don't forget to smash that like button, and then comment below and let me know what you're looking for when you purchase a dividend growth stock. You have an absolutely wonderful day and rest of this week, and God bless. Thank you.